we're likely to see a major breakout on this. And those tend to be very explosive. We may see a little bit of a digestion at the 50 level, but I think, I wouldn't trade that. All I'm saying is it shouldn't shock anybody if we see that. And even if there's a sell-off in that period, you want to be focused on this eventual move that I think it's going to happen, which is a big breakout from prior highs, and we're going to make, we usually when you come off those other periods and you break it with authority, of which gold has done a few years ago, you tend to see some monumental types of price changes, and I think that's going to be the case here.
Silver has a history of moving quietly for years and then exploding in ways that catch even seasoned traders off guard. Tavi Costa of Crescat Capital believes we're approaching one of those moments again. He points out that while silver may pause around the $50 level, where prior highs sit, the real story begins once it clears that ceiling. That's when the move tends to get disorderly and powerful. Costa stresses that industrial demand, like solar panels or electronics, is nice but not the main catalyst. Silver's core identity is as a monetary metal. Historically, it doesn't break out on its own. It follows gold. And with gold already confirming its bull market years ago, silver's turn looks overdue. For investors, this means silver miners could deliver outsized gains since they carry similar risks to the metal but amplify returns when prices surge. Short-term traders may see froth in the charts, but Costa says the bigger picture tells a different story. Step back decades and it's clear we're only at the start of a secular shift. This isn't a bubble inflating. It's the early innings of a structural repricing. The smarter play, he argues, isn't trying to time every pullback but owning quality positions built for the long cycle. Meanwhile, the macro backdrop strengthens the case. The US is running persistent twin deficits, overspending while importing more than it exports. It's the equivalent of a company bleeding cash year after year, surviving only by piling on debt. A setup that historically fuels demand for real monetary assets like silver. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Well, usually, the tendency is that we're likely to see a major breakout on this, and those tend to be very explosive. We may see a little bit of a digestion at the 50 level, but I think, I wouldn't trade that. All I'm saying is it shouldn't shock anybody if we see that. And even if there's a sell-off in that period, you want to be focused on this eventual move that I think it's going to happen, which is a big breakout from prior highs, and we're going to make, we usually when you come off those other periods and you break it with authority, of which gold has done a few years ago, you tend to see some monumental types of price changes, and I think that's going to be the case here. And it's important to know that mining companies are still trading as if silver prices are much lower. Not only that, but if you consider the fact that they're still mining silver at sub $20 an ounce, every incremental dollar increase here in silver prices is a quite significant leverage for those companies to generate free cash flow. And and especially the ones that are being smart about this situation with energy and are being able to hedge energy costs here as we see this metal prices situation come to fruition. Well, I think the catalyst is always gold, right? If you study history, and I know a lot of people have been talking about solar panels, and that just goes to show how off the track we've gone from the main thesis for silver, right? The main thesis for silver has nothing to do with that. That's great. That's just a add-on to the thesis, and it's certainly very complementary, but the real movement won't come from that. It will come from the fact that it's a monetary metal, that it's an inflationary asset that tends to perform very well when we're in a gold cycle. And I think gold has signaled that we are in a cycle. Maybe it started a while back, and I think it's just, I would say a few years back, and it's been confirmed. And the next one to see the same situation is silver. And In conjunction with that, we should see the mining companies also do the same. And so, because they carry similar levels of risk, obviously one is operational, the other one is volatile, just given the fact of the nature of the asset relative to gold and the size of the market. But these two things just, I know a lot of people are looking at a 6-month, 1-year chart of these companies and these assets, but step back 30 years, 40 years, 50 years, what do you see? We haven't seen anything, right? I mean, it's just a blip, what we've seen so far. So it's just fascinating that people are just so concerned that, we've seen enough. This is a bubble. And I was at Beaver Creek during that conference and for precious metals. And the question I got the most is, are things too frothy? What? We haven't seen anything yet. I hope I'll tell people when it's too frothy, and that would be my goal. But look, we haven't seen anything yet. I mean, this is just, it's great. It's confirmation. There's no doubt all these things look overbought here near term. Would I get in front of that overbought signal? No, that's not what I do for a living. I invest on things that are secularly changing. And if you are of that type of mentality, you don't trade things in and out like this. This is just nuts. I'm not that smart to do that, and I don't think anybody is. And it's time to be building businesses in these trends and owning things that are high quality, and buckle up. It's going to be, in my view, a very fun next 5-10 years. Yeah, I think the easiest way to understand a twin deficit issue is just like a normal company, and how that affects a company itself, right? If you're a company, you're bleeding cash every year, and when you bleed cash, you have two options. You have either dilute your equity, or you just raise money on debt. The US government has decided to do this through debt. And so what you're seeing here is that basically the US government as a company, again, has two forms of revenues streams. They can either collect more taxes than what they spend, which we all know we have a spending problem, and so we're not collecting more than what we're spending. And so we have a deficit on the fiscal front. And the second way is when you're exporting more than you're importing. And I know that there has been enough people talking about this fiscal issue, but not enough people are talking about the trade problem, of which is almost as severe. And structurally, when you go back to all the way to the 1800s, this is one of the worst we've seen. And so when you look at that and you think about, all right, well, so we have a twin deficit issue. We also have debt at, basically all-time highs. So we're compounding that debt at a degree that we've never seen before. And on top of it all, we also have a very overvalued dollar relative to other fiat currencies. I mean, I think the easy trade that everyone's focusing on is on the hard assets, which I'm not moving away from that view. Like that's still happening. It's developing. What people are just maybe dismissing is the fact, can we see other fiat currencies actually appreciate versus the US dollar, just because the US government cannot afford having such a strong US dollar? And that's probably going to be the case here. So I'm of the very strong view that we're seeing a sort of a digestion of a big move in the US dollar recently here. One of the largest declines of the DXY index since the 1970s. And I think as we see this digestion, the big question is, are we seeing a bounce of a major support, or the potential for a big break of that support that will catalyze long-term decline of the dollar versus of other fiat currencies? I am of the latter view, and I think that that's going to be one of the most meaningful trends in the macro world. And as we see that being, formed at some point here, and I think it's going to happen in near term, eventually, that's going to also drive something else, which is emerging markets. When you have a weak dollar versus other fiat currencies, and you have also a country like the US that is being forced to financial repression, lowering rates in order to afford its fiscal issues, that's not good for yields either. And so yields need to fall, the dollar needs to fall. And those are the recipes for what you tend to see in terms of appreciation of emerging markets, particularly Latin America. So I remain laser focused on the next trend, that I think it's going to be Latin America and other emerging markets that are likely to receive a lot of the flows here from these changes on the macro side.
Tavi Costa draws a sharp connection between the strength of the dollar and the fate of emerging markets. When the dollar rises, he explains, countries that borrow heavily in dollars get crushed because their debt burden balloons. Servicing those loans becomes harder, choking growth and leaving them vulnerable. But if the dollar weakens, as he expects it will, the dynamic flips entirely. Suddenly, what was a drag turns into massive leverage. Costa compares it to mining stocks. If you think the underlying metal is falling, you avoid the sector. But if you believe prices are heading higher, miners deliver outsized gains. Emerging markets work in the same leveraged way. A falling dollar acts like rocket fuel, amplifying returns across their economies and markets. He points back to the early 2000s through 2011 as proof. Brazil's Bovespa index returned 18x in dollar terms during that cycle. $1 million invested became 18 million without chasing speculative corners of the market. That was just broad exposure. Today, Costa argues, the conditions are similar. Hard assets are rising, the dollar looks weak, and emerging markets are priced for disaster. That combination creates asymmetric upside for investors willing to look beyond the noise of politics and sentiment and focus instead on the long-term setup. Let's get back to the interview.
The opportunity is to invest, in my opinion, in a part of the world that has been neglected for a very long time, that hasn't received any flows from developed markets, that has also have a very resource-rich economy that is driven by resource value. And as we see the prices of commodities rise because of this hard assets bull market that we're in the beginning of, in my view, eventually that's going to drive growth. And there's nothing, if you're an investor in equity markets, there's nothing better than finding a depressed multiple, okay, very depressed multiple, historically speaking, PE ratios, price. Now, a lot of people say, all right, a very depressed PE ratio is a value trap, is a reason for why this company is trading at those levels. Okay, think from a macro standpoint, there's a bunch of companies trading as single-digit PE ratios, okay? And what we are likely to see is why companies trade at single PE ratios is because the market is reflecting low growth, right? It's going to be no growth. Maybe they're even going to go out of business in the next few years, and that's why they have such a low. I'll give an example. Like there's remember that company Redbox where you go and rent DVDs and all that? Well, that company was trading at like 4 times earnings for a long time, after Netflix came in and so forth. And everyone was saying, well, this thing is going to go bankrupt. Well, the market was reflecting that this thing was going to go bankrupt. And so it's trading at 3-4 years. So it basically was saying, all right, this thing has maybe 3-4 years left as a business. And so, I don't think these banks, Brazilian banks, have 3-4 years left. Like, why are they trading at these such low multiples when I also have a very strong view that as we see commodity prices going up and starting flowing to the economy, which usually does, I mean, you can see all sorts of correlations of major commodities relative to Brazilian markets, Peruvian markets, Mexican markets, Argentinian markets, Bolivian markets. As we see that occurring, it's going to generate growth, right? So you're about to see suppressed multiples plus major growth. And that's nirvana for equity market investors. So I don't think people have realized this yet. And that's why the same way a few years back, I was super excited about mining and I still am, as I said just a few minutes ago. However, I think the asymmetry today from a relative standpoint, still, it probably is more in emerging markets right now. Sure. I mean, I think the biggest thing you got to watch for is how much that they have relative to their economy. And if you know that the U.S. government is being forced to devalue the dollar, okay, that's the key thing, right? This is why emerging markets get killed, is when the dollar is strengthening, they usually cannot really sustainably raise enough debt on their local currency markets because there's no appetite there, right? So imagine being a country that no one wants to invest in your country. And so when you're in that situation, the way you attract capital, you issue a bond in US dollar terms, so foreign denominated bond, And if the dollar goes up, your debt goes up. Well, that's not my view, right? My view is that the dollar is going to fall, right? So that's, it's the same thing as investing in a mining company, right? Why would I invest in a mining company if I have a view that gold prices will fall? I wouldn't, right? That's really not what I'm trying to do here. If I have a view that the underlying asset will go up, then think of emerging markets as almost like they produce dollars, right? It's the same thing as a mining company, right? But the difference, well, the difference here is that when dollar falls, it really, really benefits these countries. That's leverage on the dollar declining trend. And the fact that you can have that leverage at such cheap valuations, to me, is like, I don't need to bet the farm on this, right? Like, if I'm right about this, to give you an example, right? Because I'm from Brazil, and so I've looked at the Ibovespa index versus in dollar terms, not even in local currency terms. But if you got a movement in the dollar terms back in the early 2000s, all the way to 2011, which was the last cycle, if you put a dollar there, you made $18. Okay, multiply that. All right, if you put $1 million, you made $18 million during that period. That's the most boring way of investing there. So I actually think there's plenty of ways to do much better than that. And the reason why I got into the mining industry is because I saw the same asymmetry, right? I was like, oh, I can put a few dollars and make multiples of my money. That sounds interesting. All I need is the gold price to start moving. And then the gold price starts moving, and everyone's saying, well, the mining industry is broken. This is not going to happen. And then turns, and everyone's like, oh, I told you so. No, you didn't tell me so. Like, nobody said that. Everyone was, lost their minds and thought that structurally, mining companies only bleed capital and they will never make money. And now all those people are starting to come back and say, well, should I revalue my views here? Maybe gold prices at $5,000, $6,000 do make these companies profitable. Duh. So, it's the same thing. Like, I think people are very stuck on the same idea on emerging markets, thinking that these things are led by, corrupt governments and so forth. But so is the US. And I'm not here to say that emerging markets will change structurally. Like, we're still going to have criminals running the place. We're still going to have, people like Lula running the country. I'm sorry, that's not going to change. That's not what I'm here for. Lula was running the country back in the early 2000s, exactly at that time when Ibovespa had its run of 18-fold, right? Not during the entire time, but most of it. And so, I don't know, does that really matter? Is that where you should be focused on? Is where investors usually get hung up on, and the wrong stuff? So it's not a political play. It's a historic play on where the dollar is likely to go. And so, yeah, I just, it fascinates me how people get hung up on things that are not really meaningful.
Cycles in finance have a way of looking obvious only in hindsight, yet the patterns are often right in front of us. Silver lingers, frustrates, then erupts. Emerging markets get written off, then roar back when currency tides turn. The thread tying both stories together is leverage, hidden until it swings in your favor. What's unfolding now feels less like a short-term trade and more like the early stage of a long reset in how capital values real assets and undervalued regions. For those watching closely, the alignment of weakening dollar dynamics, structural deficits, and hard asset momentum suggests the groundwork is being laid for a powerful multi-year shift. Is this the point where overlooked assets like silver and emerging markets stop being side stories and start moving to the center of global capital flows? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.